Ira, there was a lot of talk here, at least in the Fed minutes, about the idea of balance sheet runoff and sooner than had been discussed before. Were you surprised by this?
Well, we weren't surprised. We've been calling for this actually since last summer. So we think early runoff makes a lot of sense. The big thing with runoff right now is there's about over $1 trillion of excess liquidity in the market, and you can see that in the usage of the Fed's reverse repurchase agreement facility, which was also mentioned several times in the minutes as well. And until that's kind of all run off and run down, any type of balance sheet runoff will not actually be monetary tightening. So it won't be any kind of, effective quantitative tightening until that's all gone, and that'll take about a year if they run off just with passive runoff. So just allowing maturities of treasuries and mortgage-backed securities to come off the portfolio without actually selling anything, which I think is what the Fed will do, because if they do ultimately actually sell anything, I think that's really going to spook the markets quite a lot.
Yeah, indeed, and interestingly, we're getting notes the likes of Peter Bookvar over at Bleakley Advisory talking about the possibility of shrinking their balance sheet and raising rates at the same time. Powell tried that in 2018, and after a 20% stock market correction, he got scared, of course, pivoted soon after. Talk to us about what's been perhaps spooking the market in the run-up to these minutes. In the beginning of this year, why have we seen this sudden sort of backup in yields once again when we already knew that 3 rate hikes was being baked in?
Yeah, well, the rise in yields I don't think is quite as much to do with expectations of the Fed's rate hikes. I think it has a lot more to do with new positions. So when you look at what's been going on with in the futures market, for example, there's been a significant amount of selling of positions that look to have been covered in December. So basically, a lot of people have a bearish view on the Treasury market, but they got a little scared, I think, with Omicron starting in December, and then with people worried about what was going to go on with QE, for example, in Europe. People covered a lot of their shorts and kind of got flat going into year end. And I think now that we've passed the turn of the year, where people are just resetting those positions. So but we're right at a really important technical level right now in the 10-year yield, 1.7%. That was the high from last October and November. We break through that, another 7 basis points can really get there really quick, up to 1.77, which was last year's yield high. So I do think that we're in a bearish trend right now, and it might not stop until we get to at least 1.77%.
And Ira, we're at a 1.6999 on the 10-year. So we, of course, love your technical analysis. Take us back sort of big picture. A few years ago, we had a Federal Reserve saying we're going to let inflation run hot. We're really focused on this new definition of what full employment really means. Is this a pivot back away from that?
I think a little bit. There was so much discussion in these minutes about inflation and inflation expectations not being as transitory as they thought. And they didn't even use the word transitory. They basically said it would be more persistent than they had thought several months ago, is the language that they used. And I think that that's one of the reasons why the market's bear flattening right now, is just the idea that even if they don't hike or only hike what's being priced into the market right now, they might have to go a little further. And so that's the reason why, and we've been saying that the terminal rate pricing was way too low. We were only pricing 1.5% Fed funds rate, which is basically either 5 or 6 interest rate hikes. And we think that they're going to go at least 8, maybe 9 hikes before we wind up getting to what ultimately we think will be terminal rate a little bit above 2%, which is still lower than the last cycle. So you still have this very long-term 40-year downtrend in rates, but it also means that it's more than the market's been pricing, and that's why we think we'll continue to get bear flattening of the yield curve, and something that I think will be more persistent over the next couple of months.